Most traders get excited about IPOs because they think it's a chance to buy into the next Google or Facebook right from the start. But in reality, IPOs are one of the trickiest parts of the market. If you don't know what you're doing, they'll burn you. And if you do, they can supercharge your returns. Therefore, in today's video, we discuss how to trade IPOs for massive gains in swing trading, focusing on when to enter, how to manage risk, and which setups work. For those new to the channel, don't forget to check out our library of trading videos, all derived from over 30 years of experience. We also have a fantastic group where I share all of my trades, past and future. We also have a bespoke breakout scanner, which is an area I specialize in, finding quality stocks breaking out with strong momentum whilst offering low-risk entry points. That being said, let's dive in. Starting with the basics, an IPO, or initial public offering, is when a private company offers shares to the public for the first time. It's exciting, but it's also chaotic. What most people don't realize is that companies going public usually float only a small percentage of their shares, typically 20 to 25%. That creates an artificial scarcity, which can cause explosive price moves if demand is high. But this also makes IPOs some of the most volatile stocks on the market. Retail traders' biggest mistake is buying an IPO on day one, thinking they're getting in early. But what they're doing is stepping into a hype cycle with no structure. IPOs don't behave like seasoned stocks. They need time to settle, base, and reveal their true personality. That's why the best swing traders avoid the day one frenzy. They wait for the stock to calm down, form a base, and show real strength before stepping in. So, what makes a good IPO swing trade? The most important thing for trading IPOs is that you need some trading activity before you jump in. Generally, a couple of months or more of trading activity is recommended. Most importantly, you must wait for proof, which comes in the form of a primary base, which is the first buyable base after the company has gone public. Now, different IPOs behave differently after listing, and therefore the primary base formations also differ for them. Some of them rise on day one and continue their rise in the subsequent days, and then they rest and base. The traders who made money in the initial run book profits, leading to a consolidation, and it's during this consolidation that the true nature of the stock gets revealed. An orderly consolidation, at least 4 weeks in length, with tightening price action and drying up of volumes towards the end, is desirable. A constructive consolidation near all-time highs will further skew the probability in your favor in case it breaks out with high volumes. For example, Landbridge Company, LB, in 2024 rallied 130% from the IPO day low and then formed a 5-week base, a cup with handle pattern on the daily chart. When it broke out, it rallied another 100% in 6 weeks. Then there will be some IPOs that start basing right after their first week pop. This base is a clear differentiator between stocks that truly hold potential after the IPO and the ones that were overhyped and were offloaded to gullible retail investors at the wrong time. The good ones form proper bases with contracting volatility, like Reddit, RDDT, did in 2024. The stock marked the IPO frenzy high on the 4th day after listing and formed a 29-week consolidation before breaking out to deliver a 200% return in 16 weeks. An example of a miserably failed IPO was Robinhood, HOOD, in 2021. It hit a high on the 5th day after its debut and crashed 91% in 45 weeks. It never formed a base as there was no support from buyers throughout the decline. This is a glaring sign of buyers overwhelmed by sellers who want to get out at any price. Let's address an important question now: why IPOs are special and why they work so well. First, fundamentals. Most companies that sell stocks to outside investors do so to raise money for expansion. So the money goes to work right after the IPO. The companies that are able to replicate the pre-IPO business success with the IPO money end up delivering humongous returns. Therefore, in the first 5 to 10 years after the IPO, the companies deliver strong revenue and earnings growth, which attracts more institutional interest and takes the stocks to newer highs for years. When tracking earnings of such companies, you must look for growth. It's important to look for more than just one good quarter of growth. What you need is acceleration over a few quarters. You want to see business momentum and not just a lucky bump. Second, most institutional investors are always on the lookout for new companies to put their money into as their old bets retire. What could be a better way to find new ideas than focusing on recently debuted names, which have raised large sums from the primary market to fuel business growth? Therefore, when a company delivers on its IPO objectives, it receives disproportionate interest and money from institutional guys, creating swing trading opportunities for traders like us. Now, let's bring this to life with some real examples of how popular IPOs have fared over the last many years. Take Google back in 2004. It IPO'd at $85 per share. For the first few weeks, it drifted, chopped around, and rallied. It started basing in week 12 and formed a proper consolidation. Then it broke out. In 38 weeks, it rallied over 130%. It was a lateral consolidation setup just after the initial move. It ticked all the boxes: strong fundamentals, a clean base, and breakout volume. Compare that to Facebook in 2012. It IPO'd at $38, but its fundamentals were shaky. Earnings growth was slowing ahead of the listing, and there was no real base formation, and the hype was through the roof. Result: the stock collapsed, falling below $20 within a few months. It didn't become a viable swing trade until much later, after it built a foundation and started growing again. There's also Zoom, the popular video conferencing company that debuted in April 2019. Thanks to rising popularity in the pandemic and improved earnings prospects, the stock went up 460% in 33 weeks once it broke out of the first base after the IPO. These examples show one key thing. It's not about getting in early, it's about getting in right. Now let's talk about timing. The timing of trading IPOs is no different than regular swing trading. Depending on the time of the IPO, you will get opportunities to trade them. If the IPO has come at the start or middle of the bull market, you can look for setups in them as you would in other stocks. Once you spot setups, you can trade them as regular swing candidates breaking out of bases. However, a barrage of IPOs are thrown at investors at the peak of the bull run, and as the market turns into a correction or a bear market, most of them fall with the market. The real test happens after the market gets settled. Some of those IPOs stop falling as they react to evolving fundamentals, and the others continue to get battered. The ones that find their feet display leadership characteristics. They respect previous lows, see high volume on up days, low volume on down days, and regain the lost grounds as soon as the news flow gets positive. For example, Netflix went public in May 2002, when markets were still under pressure after the dot-com frenzy. Netflix fell 70% from its high due to the severity of the fall in the market. However, as soon as the broad market selling was over, it quickly recovered, forming the IPO base and breaking out into new highs to deliver a 350% return in 45 weeks. Now let's look at some other important elements in IPO trades. As IPOs often have short trading histories, most indicators are rendered unusable. Therefore, your best friend is price action and relative strength in such times. You must keep an eye out for stocks doing better than the market, approaching new highs after forming proper consolidation. Next, use key moving averages to guide your trade. The 10-day, 21-day, and 50-day EMAs are critical in IPO trading. If a stock pulls back to the 21-day and bounces with volume, that's often a great swing entry. If it slices through the 50-day with heavy volume, that's your exit. IPOs are brutal when they reverse, So your stop loss isn't optional, it's essential. Also, watch the volume. Breakouts that happen on 50% or more above average volume tend to follow through. Breakouts on weak volume? Often fakeouts. Make volume your confirmation. Now, there's something else you should keep in mind: sentiment. A lot of IPOs attract short sellers early because valuations are stretched. But short sellers can be fuel for rallies because they eventually have to cover, creating even more upwards pressure when the stock recovers or breaks out. Now let's talk about managing your gains. If you're up big on an IPO swing trade, don't give it all back. Have some mechanisms to sell in strength. This could be the stock price's distance from a crucial moving average, like a 50-day or 100-day, or you could trim your position at a high multiple of risk taken, like 10x or 15x. Once you've locked in partial gains, you can trail the rest of the position using a moving average, or simply exit as soon as the price breaks the previous swing low. That way, you still profit even if the stock reverses hard, like it happened in Zoom and DocuSign. And finally, how do you find these IPOs in the first place? Simple. Use a stock scanner. Set filters like IPO date within the last 1 to 3 years, minimum daily dollar volume of $20 million, price above the 50-day EMA, revenue and earnings growth above 25%. Then, sort by relative strength. Look for tight consolidations, check for earnings catalysts coming up. Keep an IPO watch list and update it weekly. This gives you a steady pipeline of potential setups. The truth is, most IPOs fail. A small handful will go on to become legendary winners, and your edge comes not from predicting which one, but from identifying the handful that are showing strength, backing it up with volume, and breaking out from valid bases. So the next time you hear about a hot IPO, don't chase it. Step back. Ask, does it have strong fundamentals? Has it built a base? Is it breaking out on volume? Is the market in your favor? If the answer is yes, take the trade with a plan. If the answer is no, walk away. There will always be another one. Thanks for watching.